So we've all heard the golden rules of investing. Take your money, split it 50, 30, 20 across large, mid cap, small caps, or just take your money, put it in index funds and watch it grow. But as I was planning my own investments for 2026, I thought, let me see if there's any data to support these thumb rules. And unfortunately, I didn't find much. So I did something a little nerdy over the New Year break. I sat down with AI Studio and I ended up building this backtesting tool. So in today's video, I'm going to be sharing the raw data and the findings from the backtesting tool. I'll actually show you the tool and hopefully that should give you some clarity as you think about your own investments. Two questions that I'm going to be answering in today's video. This is going to be a multi-part series. In today's video, two questions that I'm going to be answering. Number one, what is the ideal allocation, or historically in the last 5 and 10 years, what the ideal allocation would have been between large cap, mid cap, and small cap funds, right? That's point number one. Second thing that we're going to be covering today is what is the active versus index fund data suggest. Are active funds truly as bad as they are made out to be? Are there nuances there in certain categories? Active funds could do better than index funds. So we'll also compare all of that and you will have an answer around that. Before we proceed, I want to give a disclaimer that this video is for research purposes only. This is a research exercise using AI models and backtesting. It is not investment advice. The goal is to demonstrate how data and AI can be used to analyze investment strategies and challenge some rules. I am not a SEBI registered advisor. All past performance data is not indicative of future results. Please do not base any financial decisions based on the video today. This is just a research exercise, so please take it in that spirit. I will not be recommending any mutual funds. With that, let's jump in.
This channel is brought to you by the 01 Media Network by Zerodha. With their support, I'll be helping you spend your money wisely.
So to structure this video, think of the mutual fund universe in a 3x3 grid. You have probably seen this grid before. There are two quadrants on this grid. On the one side, you have market capitalizations, so small cap, mid cap, large cap. And on the other quadrant, you have factor style of investing, so value, blend, and growth. In today's video, I'm going to be only covering the market capitalization bit. And so we'll go deeper into small, mid, and large caps. We will not be touching the factor investing. Like I said, this is a multi-part video. And so in the next video, when I come, we will talk more about factor investing. So make sure you're subscribed if that's something you want to know more of. Now that I have this backtesting tool, I'm actually super excited to be sharing more insights about mutual funds with you going forward as well, because it just makes things super easy and simple. Okay, let's jump into the first question of the day, which is the 50, 30, 20 rule. If this thumb rule truly works, or is there a better way to allocate our money across these different large caps, right? So before we start, let's ensure you're on the same page. When I mention market cap, large cap funds are top 100 companies by market cap, mid cap is next 150 companies, and the small caps are the next 250 companies, right? The methodology that I've done in order to arrive at these back tested, and this is important for you to understand so that you know what the pitfalls of the model are. There are 3 steps, right? And we'll go through all 3 steps together one by one. We'll only do this once so that you know how this actually works. And then later on, I will just show you the results because I don't want to make the video too long. So step 1. Identify top index funds across market cap, right? And 2 factors that I looked here. One is the AUM and the second is the tracking error. Let's do this together. I'll quickly open ticker tape and it has opened up on my portfolio only. Unfortunately, I will not show you my portfolio, but I'm on that pro version. I can quickly show you what I'm seeing before I jump into the screener, which is that I spend most of the time. But the pro version actually has a category level split, subcategory, index funds, ELSS, equity, mutual fund breakdown. Where are my current sectors where the money is invested? This is another cool feature, diversification score. So it shows that I'm over diversified compared to the rest of the ticker tape community, which is okay. I don't really have any qualms about it. I'm not looking actively at my mutual fund portfolio, and which is why I'm now making this video to learn more about it and see how can I invest better going into 2026. It also shows your XIRR compared to the category average and how your funds are doing. So these are some of the funds that are doing well, some of the funds that are not doing as well. Index funds are actually not doing as well. This is over a 5-year period, 2015, 6 months on. 6 months, my XIRR of the portfolio is higher than the category average. Over 1 year also it's higher. Not bad, not bad. 3 years, it's slightly lower. 5 years is lower, definitely. But anyway, this is a cool little feature. But let me jump into the screener part of the mutual funds. Now, this is where we have to start by identifying the funds, right? So let's go into this. Let's start screening. Okay, so I have to find index funds. Let's go into equity. Let's select index funds. Downshift by AUM. So yeah, these are the top AUMs. Now I also want to add tracking error to this. So let me add tracking error from here. This is added tracking error. So there you go, UTI Nifty 50 index fund, highest AUM, highest tracking error. So we'll select this. Now we need to identify next 50 index fund. ICICI Pru is here, but has a slightly higher tracking error than UTI Nifty Next 50. So we'll identify UTI Next 50 index fund. Same approach. I've taken this before, and so I'm not gonna spend too much time on it. But Motilal Oswal comes up on top from a mid cap 150 index fund. And similarly, when we scroll down, we will see this Motilal Oswal Nifty Small Cap 250 Index Fund. So we'll take these and we will use them in the calculations ahead. So that's our step one done. Now step two, downloaded the historical NOEs of all of these funds. Here is the sheet where all the historical NOEs are. There are a lot of tabs here. But essentially, UTI Nifty 50, this is the historical NAV using a Google Finance function. I've also put the expense ratio here. The reason the expense ratio is there is because I wanted these returns to be net of expenses and not before expenses to give you like a better indication of what the returns would be. Similarly, in UTI Next 50, Midcap 150, Motilal Oswal 250. So those are our different funds, right? Step three, most important, we'll input this into the backtesting tool that I made using AI Studio, and I'll show you that in a minute. But before that, know three things. One, this is a simulation where the person is doing a SIP of 50,000 rupees every month for the last 5 years, 10 years period. There is no increment in the SIPs. It's a 50,000 SIP at the start of every month, right? Usual to what most people do. Second is, this is last 5 years data, November 2020 to December 2025. There's also 10-year data, which I'll show you shortly from start, almost 11 year, in fact, Feb 2015 to about December 2025. And this is all of net F expense ratio, which I've already mentioned, right? Now let's jump into the backtesting tool and show you how it really works. So this is a screen which has the backtesting tool. I will run one simulation for you. I will go here, pick this up, fund one, tab name. I will type UTI Nifty 50 is what we need here. I will reduce the allocation to 25% of this. Then I will do UTI Next 50. Allocation will be 25% again, right? Now we'll add our mid cap 150, which is 30%. And then we do our fourth one, which is small cap 250. That's what, oh, sorry, Motilal Oswal 250. So MO 250. I am going to select the dates of this. Monthly investment is 50,000, like I already mentioned. Start date here will be our 2020 October end, 5-year period. So when we run the back test, the result will shortly come up. So now we saw the backtested result. I've just taken a screenshot of that and put it here. What we invested was 31 lakhs, 17.4% XIRR, net of returns, maximum drawdown of minus 16%, ROMAD of 1.1, volatility of 14.4%, right? What is ROMAD? Very quickly, ROMAD is a metric to look at risk-adjusted returns. It's basically the XIRR that you got divided by the maximum drawdown that your portfolio saw. So in this example, it's 17.41% divided by 16.12, which is about 1.1. What I want to do is maximize for risk-adjusted returns because you don't need to take a lot of risk if you're not getting the return. And so how do you look at that? The second one to look at is also volatility. ROMAD drawdown is a maximum dip your portfolio sees. Volatility is day-to-day ups and downs that your portfolio sees. So you ideally want to be maximizing the return over drawdown and minimizing the volatility. And that's what we are trying to be optimizing as we move forward. So yeah, now that we have what ROMAD is, let's jump into, is there a better allocation? And so for this, what I did was, again, in the backtesting model, I told the model that I want to run Monte Carlo simulations. Monte Carlo simulations, you can Google it separately, but it's a very simple concept where the model takes different allocations. You can tell it how many. In my case, I've told it to take 1,000 such different combinations of allocations across large, mid, and small caps. And then whichever allocation has the maximum ROMAD, show me that result, right? And so when I did that, here's what I got. Same period, same funds. I got an XIRR of 20% in the new allocation, and I will show you what that allocation is in a minute. Maximum drawdown went down to 9.65%. Remember, our maximum drawdown here was minus 16%. It has gone down to minus 9%. Our returns have gone up from 17% to 20%. Our ROMAD has almost doubled from 1.1 to 2.08, which is amazing. And even the volatility, which is the day-to-day ups and downs, has gone down from 14% to 11%. So amazing, amazing results all across, right? And that's what I'm trying to show you, that using AI, you can now build your own strategies and not take thumb rules or follow me, and I will share them with you. But optimize allocation heavily towards mid caps. This is the new ideal weight. 25, 25, 30, 20. The ideal weight was 18% in Nifty 50 and 81% in mid caps, right? And 1% in small caps. So it's almost eliminated the entire small caps and an entire Nifty Next 50 in the last 5 year period. Now, look, you can argue that this is a 5 year period. In this last 5 year period, small caps have not done much, and that's why hindsight is 2020. You can now look back and very conveniently say that had I put all my money in mid caps, they would have done well, and I agree, right? That's why I started the disclaimer that past performance is no indicator of future performance, but at least know what this is a good learning exercise for all of us to know at least what the past exercise, what the past allocation looks like. So now let me actually extend this from a 5 year window to a 10 year window. Okay. Before I jump to that slide, I also want to caveat that there is no fund in small caps which was investing in the small cap index over a 10 year period. And so I could not run it with the same funds. What I have done is I have looked at the index because the index NAVs are there for the last 10 year period. So I looked at the index. What that means is there is no tracking error and there is no expense ratio. And so the returns will be slightly inflated. And so it's not entirely apples to apples with the 5 year and the 10 year window, but within the 10 year window, it's going to be apples to apples. With me? Okay. So the setting has changed a little bit because I have shot this in multiple settings and it's cold in Delhi. So how does this 50, 30, 20 split look over a 10 year period, right? Now let's look at that. 50 large cap index, 30 mid cap index, 20 small cap index. You get an XIRR of 15.7% at a ROMAD of 0.58, right? But then I asked myself that, can we do better? What is the ideal weight? And we ran the Monte Carlo simulation again. What we found out is that the weight is here, 4% in large caps, in the Nifty 50 index, 62% in Nifty Next 50 index, 4% in mid cap 150 index, and 30% in small cap 250 index. So it has actually over a 10-year period increased the allocation from 20% to 30%, at least in one of these scenarios, right? Monte Carlo simulation, there'll be hundreds. This is the one in that particular scenario that won. But like, obviously, if I run it again, there will be another simulation. So there will be another ideal weight that would come up, right? So keep that in mind. But yeah, it looks like over a 10-year period, small caps have somewhat proven their mettle. But still the majority is in mid caps in Next 50 and mid cap 150. I'm taking Next 50 also as like 51st to 100 company within the mid cap zone. But yeah, that's how it's looking. The other interesting part to note here is that the XIRR is actually lower in the ideal weight compared to the traditional weight. But like I was saying earlier, the risk is also the drawdown is lower, and therefore the risk-adjusted return is actually slightly higher in the ideal weight. All right, second question, active versus index funds. Let's jump in. So first, very, very important thing to note here is survivorship bias. What does survivorship bias mean? It basically means that I'm only looking at funds which have survived, right? Which have done well. And therefore, that's not the right approach. And so I wanted to change my methodology and adjust it a little bit. And I'll show you how I've done that. But the problem with survivorship biases is like picking up the winners of a race after the race is over, right? And that's not fair because when you were starting the race, you didn't know who the winners were going to be. So what I did was, in order to avoid this survivorship bias, I went back in time. I went in 2015, did some research on what were the active hot funds back then that all blogs were talking about, all value investing, Morningstar, Dhan. I found a lot of different blogs on what are these hot AMCs and what are the hot active funds that if you would have done like 10 minutes of research, you would have seen their names and you would have probably gone and invested in those, right? The same thing I did for 2020, picked the hot funds across large, mid and small caps for that 5 year test period. And then over the last 5 year and 10 year periods, I compared them with the index funds, which are obviously common, which we've identified in the last segment anyway. Right. So that's what I did. These were the hot active funds. Okay. And I've linked out the sources here and I'll show you those as well because I feel like being transparent is important. So 2015, the large cap, which was doing the rounds back then, which was awarded by Morningstar and covered in a whole bunch of different articles as well, was a Franklin India Prima Plus. Now it's called the Franklin Flexi Cap Fund. Okay. Mid cap, it was HDFC mid cap. And in fact, I found this. So if like you look at this one, right, Morningstar 2015 awards, you will see Franklin India Prima Plus here. You will see HDFC mid cap opportunities here. You'll see Franklin India smaller companies here. And that's where the small cap also comes in, Franklin India smaller companies. Similarly, 2020, the hot AMC back then was Axis large cap, Axis mid cap, Axis small cap. Again, rewarded, talked about in different blogs. Everybody was talking about these funds back then. And so these are the hot active funds that I've taken for the backtesting purpose to compare it with the index funds that we've already identified in the previous section. Okay, coming to the third section, the 5-year showdown. How do the hot favorite funds from 2020 compare to the index over this 5-year period in the 50-30-20 split to begin with? So let's look at this, right? Over 5 years, the index has delivered a higher XIRR but lower ROMAT than active funds. And now the active funds here are these three here: Axis Large Cap, Axis Mid Cap, and Axis Small Cap funds. The XIRR is 14.9% only compared to the indexes. This is again the UTI Nifty 50, the UTI Next 50, the Motilal Oswal Mid Cap, and the Motilal Oswal Small Cap funds. The XIRR here is 17.4% over the same period. The index actually did better. The drawdown, however, in the active was better. They were able to manage the drawdowns better at minus 11% broadly, and therefore the ROMAD of the active was better. But yeah, I mean, it's very neck to neck. It's not a clear winner that the active was better. And active also comes with that uncertainty that, hey, what if these funds are not doing well at any given point in time? Do I need to? Axis also went through a whole crisis of their own, right? So yeah, I think that's the data. That's what the data suggests, that the Roman is higher in active compared to the index, but just slightly. What if we expand this to a 10-year period? What happens then, right? Now let's look at that. Okay, now we look at the 10-year period. Remember, the 10-year is on the index, not the index funds. So no tracking error and no expense ratio, and that's why the returns here will be slightly lower. But if you look at the index first, let's start with that. The XRR is at 15.7%, max drawdown is minus 27%, Roman is 0.58. If you look at the active portfolio of Franklin Prima, HDFC Midcap, and Franklin smaller companies in the ratio of 50-30-20, the XRR of the active is actually higher. It's almost 17%, which is higher than the 15.7 of the index. But the max drawdown is also higher. It's at minus 31 compared to minus 27. And that's why the ROMA is exactly the same. And which is why the conclusion that because the ROMA is the same, you're probably better off investing in the index over this 10-year period, as the data suggests. Because you can just set and forget it. Again, you don't need to worry about how these three funds are doing. Are they still being managed by the same people? Have they had a shift of priorities and so on? None of that, right? You could just set and forget in the index over a 10-year period. While the returns would be slightly lower at a risk-adjusted basis, I think you're fine, right? So that was interesting. Now the next section, I thought that right now this was an allocation based on 50-30-20 between large, mid, and small caps. What if we just look at large cap and how the index does there? Just look at mid caps and just look at small caps, right? Because a lot of people, at least the thumb rule is that within large caps, you are better off buying direct. But let's see if that's true, right? And so for that, what I did was I went to ticker tape. I went by large cap, looked at the top 10 funds by AUM, top 9 to be precise, top 9 funds by AUM, and then compared them against the UTI Nifty 50 index fund and saw what the returns were. If you had invested 50K in SIP across each of these funds back in 2015, how much did you make now at what ROMAD? And similarly, how much did you make in UTI Nifty 50 and at what ROMAD, right? And so let's see if the index within the large cap did actually better, or was it better to invest in actively managed. In the large caps, what we see is these are the two indexes, ICICI Next 50 index and UTI Nifty 50 index. And as you can see, the UTI Nifty 50 index is right at the bottom when it comes to the XIRR. While the XIRR is higher than some of them, like the Axis large cap, but if you look at the ROMAD, which is what we consistently looked at in this video, the ROMAD is not high. It's the lowest amongst these top 10 funds. The next 50 index actually does better. It's in the 4th place at a ROMAD of about 4.58, which is better than like these 5 other funds, right? So mixed bag again, but Nifty 50 index standalone did not do as well as some of the largest large cap funds in the last 10-year period, right? From Jan 2050 to December 2025. Now let's move on to mid caps. Again, similar approach. Went to ticker tape, took mid cap funds, these top 9 funds, and pitted them against the Motilal Oswal mid cap 150 index fund, right? Now let's see how the response was. Same methodology, 50K in SIPs over 10 years. You know the drill. So yeah, how was the mid cap index performing compared to the largest mid cap actively managed funds? Let's look at that. This is better. The mid cap 150 index is actually at 23.8%. Remember, this is actually the index fund. So it's not the index. These are all index funds, right? So expense ratio and tracking error is taken into account. This is the Motilal Oswal Mid Cap 150 Index Fund. The ROMAD here is 1.38, which is actually better than 5 other actively managed funds over this almost 5-6 year period. Where there's Kotak, Axis, Mira, DSP, UTI, they fall below the Motilal Oswal Mid Cap 51 150 Index. And then these are the actively managed funds that do better than this over this period. Why this period? Because that was the only common period amongst these 10 funds. This actually Motilal Oswal 150 Index Fund started in around October 2019, and that's why I want to take the common period so I can actually compare it, and that's why you'll see the period varies. So yeah, the index fund in mid caps actually has done reasonably well when compared to the actively managed funds. Let's jump to small caps. Here are the top 9. There are some of your usual suspects. There's Bandhan here. There's HSBC small cap here. There is Kotak small cap, Axis small cap, Nippon India small cap. So very popular small cap funds compared with the index fund, which is the Motilal Oswal 250 index fund. Now in small caps, it seems like active managers have an edge. If you look at the index fund here, this is Motilal Oswal 250 index fund. The ROMAD is 1. And when you compare it to all the other largest actively managed funds, the ROMAD is on the lower end. Only one is lower than that, which is Kotak small cap. And so it looks like that the index fund were okay on returns, 21.6%. Risk adjusted returns were not as well. And so I think these other funds were able to manage volatility a lot better with small caps, especially given they've been very turbulent these past few years. And so I think it wasn't all that bad to be investing in any of these. But again, it's hindsight, right? So just want to caveat again that hindsight is 2020. This is all backtested data. Future performance might vary. Small caps haven't done anything for the past 5 years. Maybe they do something in the next 5 years. I'm no soothsayer. I don't know. But what I'm trying to show is that historically, this is what we know. And hopefully that gives us some clarity as we think about 2026 and beyond, right? So that brings us to the end of today's video. I think going back to the 2 questions that we started with, the first one is on our allocation, portfolio allocation. Over a 5 year period, we saw that over a 5 year period, 50, 30, 20, the skew was very heavily towards mid caps. If you were invested more in mid caps, you would have done better from a romance standpoint. Over a 10 year period, the skew was higher on Nifty Next 50 and slightly higher on small caps. And so over a 10 year period, small caps were actually not all that bad. Right? That's the first part. The second question that I promised you to answer is around active versus index. Looks like index has done better than all the active, the hot favorite active funds from 2020 and the 2015 or at a ROMAD level, while the active funds might have given a higher XIRR at a risk-adjusted returns level, the index was actually better. Then we went deeper into large cap, mid cap, and small cap funds. Within that, we saw that in large cap, the UTI Nifty 50 index fund was actually right at the bottom. Nifty Next 50 was in between on 4th place compared to the largest 10 large cap funds. Then we went into mid caps. We saw that the mid cap index actually held its own. It was somewhere in between on the 5th position. And so not all that bad compared to the actively managed funds. And then finally, we looked at small cap index compared to the largest small cap actively managed funds, and it was right at the bottom, right? So the small cap index was probably not able to manage volatility as well in the last 5-6 year period compared to the other actively managed funds. So that brings us to the end of today's video. Hopefully you enjoyed that and found that useful. I really had a lot of fun with this backtesting tool. Tell me in the comments, what are some of the other things that you want me to test out? Now that I have this tool, I can just keep playing with it and keep sharing insights with you. The idea really is to build foundational knowledge, use our own data to sort of build hypotheses, build foundational thinking and understanding of mutual funds and not just go by what the hearsay in the market is and so on. And so, join me on this journey. Make sure you subscribe and I look forward to the part 2. Thank you and see you in the next one. Bye-bye.